Welcome back to the latest edition of the InvestTalk market analysis for the week ending August 8th, 2025. Appreciate you all tuning in and liking and subscribing to this channel. First, I'm going to start off with the title of today's video, which is Market Shakeoff Stagflation with Robust Liquidity. And I'll show you why the market, still remains relatively strong, despite an economic situation that certainly is weakening and becoming stagflationary. So we'll get into that in a second, but let's take a quick look at the heat map for this week. You can see kind of a mixed bag. There's definitely some pockets of weakness. You see that in the finance space from Visa, MasterCard, Berkshire, Bank of America, Wells Fargo. The large banks not doing well. Smaller banks doing just fine. Anything private equity related did well with President Trump allowing private equity and 401ks now. Retailers did well despite Amazon's poor earnings, but Walmart, Costco, they held up. Lows. The consumer staples, those also continue to do well. On the tech side, though, you definitely had a mixed bag. A lot of the cloud names from Intuit, Salesforce, IBM, Adobe, all down on the week, but a lot of the Mag 7 hanging in there. Apple up 8% on the deal around investing more in the United States manufacturing. NVIDIA up 5%, Broadcom up 6%. So the AI trade still remains strong. Okay, so that was the broad swaths of the market this week. You had consumer. Let's get to the economic news. We had the durable goods new orders that came in with a sharp deceleration. Now, I think there's a lot of this is hard to really unpack because of the tariffs, right? Are they front-running tariffs? Are they pausing because of uncertainty around tariffs? I don't really take a whole lot of stock in that, but we did get that on Monday. The big news for the week was the ISM Services Index, PMI index, and so overall, it came at 50.1. The expectation was for this to come into around 51.4, so an acceleration from June, and we came in at 50.1. So remember, anything above 50 is growth, below 50 is shrinkage, and we're barely growing. You call that kind of neutral. Then you dig into the subcomponents. You had employment index that ticked down again, 46.4, and then you had new orders that stayed in growth territory but ticked down to 50.3, excuse me. But the stagflationary part was prices paid index. That was expected to decelerate again, but it actually accelerated to this most recent cycle high, highest level since February, January of 2023. I don't know why I have hiccups right now. Interesting. So that was the ISM Services Index, very, very stagflationary. And then on Thursday, you had the jobs data that we get every week, which is initial claims, continuing claims. Initial claims ticked up, but nothing out of the ordinary. We kind of been in this 225 range for the better part of a year. So if you draw a line through here, it's kind of average for the past year. So that's not really the issue. But the issue is getting jobs, creation of jobs. And this kind of aligns with the BLS number that came out, or the adjustment on Friday. And you can see here a sharp increase in the number of people that are staying on the unemployment doles, right? So they get laid off, right? This is initial unemployment, and then they stay unemployed and they're collecting unemployment checks. And that's what this number is. And so there's not a lot of jobs being created. There's not a lot of firing, right? Beyond what you've seen over the past year, but there's not a lot of job creation as well. So it's corroborating that, as well as the ISM services. Remember, services are 75% of the economy. Okay, so this is far more important than the manufacturing PMI, although people do look at that. But services are far more important. So if 75% of the economy and roughly 75% of the jobs are in the service sector, and you have, where is it? There we go. The employment index at 46.4, that means this is shrinkage, right? Not growth of jobs. Okay. So that's the stagflationary environment we're in. And then I want to get to liquidity. And so, the markets stay relatively buoyant, and I think that can probably stay buoyant longer than you think. But I want to get to this because this is going to start to color the liquidity dynamics over the next 6, 9, 12 months. And I want to first start off with the Treasury surplus and deficit over the trailing 12 months. And this is the last 5 years. And I want you to notice something. When was the last time this went up, which means the deficit shrank? That was in 2022. What did the market do in 2022? It had a big drawdown. Where did we bottom in the markets? In the fall. Why? Because the deficit started to increase again. Okay. And it's been relatively steady since. Okay. So what you're starting to see though is the deficit's falling. Now, how much of that's tax receipts, savings from Doge, et cetera? Probably a little bit from Doge, but mainly this is tax receipts going up. Okay. Uh, and but it doesn't really matter, right? What it is. It's the fact that the fiscal impulse is starting to trend negatively, and that is negative for liquidity. Now, granted, this is not a huge change. You're talking about going from 2.1 to 1.9. It's still obviously a massive deficit. But if this goes down considerably, and I said this with Doge, and that was one bearish potential outcome of Doge that cut spending dramatically quickly, and that would probably precipitate tighter liquidity and a recession. Nonetheless, the deficit is shrinking at a modest pace. So be aware of that. And I'll be monitoring this to see if this continues to this line go up, which means the deficit decreasing. And year over year, right, it's still year over year, it's roughly flat. If you go back to, where are we? Oh, here we go. June, 1.5. It's still year over year, it's still up, okay, from 1.57 to 1.9. Okay, so the growth is just decelerating. I think once you get to, September, October, right, now suddenly it's a negative territory. And I think that's where you could get issues with the liquidity dynamics in the market. Okay. This is another aspect, the Treasury General Account. So when this is going down, that means money is being drawn out of the checkbook of the Treasury and going into the economy. When it's going up, that means that they're issuing bonds and they're refilling it. Now, it also depends how they're doing. Are they issuing T-bills or are they issuing long duration bonds? With long duration bonds, that hurts liquidity more than T-bills. So understand that. But this is going up, so this could be another impetus for the recent market volatility. Another aspect of liquidity is lending. The Treasury and the Fed, they're not the ones that mainly create dollars. It's actually the banks by lending. And this is still trending higher. So 4.7%, kind of in line with where we've been year over year. So no real issue on that front. Okay, so for now, liquidity is fine. But you're starting to see the potential for liquidity to inflect over the next 3, 6, 9 months. And we'll continue to watch that. Now, the Fed had a meeting last week. If they saw the jobs numbers, they probably would have cut, but they didn't. But it's pretty clear now that the Fed will cut in September. 89% chance of that. And by December, what you have is a 50% chance roughly of 2 cuts and 41% chance of 3 cuts, 10% chance of 1 cut. Very small chance they won't cut at all. So we're clearly going to go into an easing cycle. So just a heads up on that. Let's take a look at the markets. So NASDAQ, nice rally on that sell-off, but did we break above it? That's a good question. That high was 21,464, and we closed at 21,450, so no. We did not break above the high from last week, so that is still generally negative, right? Near term, right? We're still within the highs. If we close next week above last week's highs, then that was just a little market pullback, nothing really to worry about. What else? Move index. This is the volatility within the Treasury market. This still looks fine, right? Below 100, no real issue on that front. So no real red flags there. This will also be a sign of liquidity becoming scarce, is when this starts to rise, and that will cause more problems. Right now, no issues there. Let's look at the S&P. The S&P kind of similar to the Nasdaq, a bit weaker, but still kind of near term, short term. I expect a consolidation period, modest pullback, and maybe another push higher before liquidity finally inflects. But for now, you have to be neutral to bullish on the markets. Let's take a look at some of the private equity names. What's interesting here is we had that news from private equity up today, but it's still kind of negative on the week. Here's Apollo, here's Blackstone, right? Didn't get the bounce that the whole market did, right? So something to consider is KKR, same type of thing, same type of pattern, kind of bearish, to be honest. Here the banks kind of bearish, same kind of thing. So financials didn't do very well this week. Okay, so that's definitely of note. Let's take a look at some of the sectors. XLK, so technology, even though Nasdaq did well, technology still well below last week's high. Communication, that's actually kind of weak too. It's a pretty hefty part of the market. Energy, weak on the kind of a tough week. Financials, not a great week. Industrials, so kind of flat. This is kind of, you're looking at the actual sub indices, you're not really getting much. You get strength out of really the sectors that you don't want to see strength out of. Consumer staples were strong. The REITs were weak because of bonds. Utilities, decent week. So money moving into utilities, staples, consumer discretionary having a good week. But a lot of these sectors didn't really have that great of a week. So I think that's interesting. Then you look at like the cloud names. So here's Sky. Here is CLOU. That's very weak, right? So that's very interesting. What else? It's a hard assets. Let's look at base metals. Actually, a very strong week. Ag, strong week as well. What did the dollar do? Dollar down on the week. So that you got that rally in the dollar, but with the economic data, stagflationary environment, and this easing cycle, it's going to be hard for the dollar to get too much traction. And you look at the long bond, actually was flat to down this week. Okay, let's go to a weekly chart. See what this is, the TLT. So 30-year bond. Yeah, negative week. So that's not really gaining any traction to the upside. So I continue to be underweight kind of longer duration assets. Here's IWV. This is so you have that reversal bar. This is the Russell 3000. This is a broader index. Definitely going to get more color out of this one. And until we break above last week's high, especially in the IWV, like I said, I still expecting a modest pullback in markets. Gold. Let's take a look at gold real quick. Gold's strong, right? We had a lot of volume today. We had some kind of rumors. It seems like there's going to be some tariffs on gold, and they pulled it back. I think it's a little unclear about tariffs on the gold lending space. What else do I want to get to? Let's look at foreign stocks. Strength, right? Weaker dollar. Here is EFA to the Russell 3000. So strong here. You have that breakout in foreign stocks, and you have this kind of broad flagging pattern. And we're in this kind of recent downtrend from the April lows, but to me, this is still relatively strong, right? Even though you've had this strong rally in U.S. equities, that certainly outperformed. But since the year, we're still up. The foreign equities are still outperforming domestic equities. So I still like incrementally adding to foreign markets. Let's look at small caps to Russell 2000. Decent week, actually, right? You have this bottoming tail on the first, on that jobs report. And they'll benefit from an easing cycle, right? So I think you could see the small caps start to outperform. I think there's potential here. Because like I said, it's lower interest rates are going to help small caps more than large caps, right? With large caps, especially the Mag 7, they have a ton of cash in the balance sheet. They're investing in short-term treasuries, right? Whereas small caps, they have a lot of debt and default risk, right? So if you go through an easing cycle, I think that could be good for small caps in the near term, and I'm starting to see a bit of signs of that. So that's where we're at in markets. I'll kind of wrap it up there. Maybe I'll go with the home builders lastly. I think there's some nice strength here. They're going to benefit from an easing cycle as well, like potentially lower mortgage rates, etc. So I kind of like that space. We're incrementally adding there. So yeah, I think that about does it. I gave you a good rundown of the stagflationary environment we're in. That liquidity could inflect over the next 3, 6, 9 months, but we're not there yet. And any pullback in markets, which I think are still seasonality. Remember, August, September are not great months typically for equities, but it's hard to see anything major with the liquidity dynamics that remain relatively supportive. So don't get too bearish too quickly. It's a time to maybe reposition your portfolio, rebalance your portfolio, trim the speculative names. I do think, if you look at like an ARKK, these are full of names that I call it Ponzi finance, right? Companies that don't make money, that burn cash, etc. So, if this ever wants to pull that, it will at some point. But this is I know this has moved pretty far, pretty fast. So this is a time where those more speculative names that don't make money, there we go, and you can see this is starting to show some weakness. And this is usually the first kind of canary in the coal mine. Same with the SMH. So you've seen a consolidation, a bit of weakness. You see the MACD divergence here on a lot of the semi names. So I think there's some potential weakness in that space as well. So a time where market's overbought, probably consolidation pullback, probably for one more run before liquidity inflects. And yeah, that's my assessment of the market for this week. Appreciate you all tuning in, liking and subscribing. I hope you have a wonderful weekend. And reminder, the contents of this video are for educational purposes only and should not be considered as a recommendation to buy or sell a security. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.